Rennick, good afternoon. We've got equities holding in right now. Stocks looking pretty decent. It's pretty quiet, basically. All quiet on the December front as we head into the season for the Santa Claus rally. It's looking like maybe we'll hit that seasonal bounce because there's just not a lot of drag. You got a little bit of drag from crypto and Bitcoin, which is not doing so well right now, but otherwise, market's holding in. Nothing really big in terms of news flow. The economic data was all right. Nothing really to write home about. Jobless claims did come in a little bit lower than expectations. But then you had some other mixed report from ADP employment yesterday, Challenger job cuts. But overall, I like the jobless claims as a pretty major indicator, obviously. So the fact that we saw them come in below expectations is not bad at all. I think that generally, if you're looking for a reason to buy stocks, it basically comes down to AI and it comes down to the overall tech theme. And you see tech again holding in today with NVIDIA having a pretty good session. So that I think is generally very encouraging. Also, again, the fact that you had this big rout in crypto, but it didn't cause any problems is very encouraging. The risk radar has been reflecting that for that reason. Because it has, been a nice dispersion trade, basically, a nice decorrelation, uncoupling, if you will. So overall, stocks are hanging in there. We've got a little bit of a bounce in the dollar today, up about 18 bips, but not really a lot to say there. We are watching, I think, the odds of a Fed cut being extremely high right now for next month. It looks like that's basically a certainty at this point. So that's probably going to keep the dollar somewhat under some pressure. Watching bonds as well, which have been sort of meandering with the 10-year right around 4.1%. But the chart overall has generally held for bond bulls. So there's not a lot of macro disruption happening. And gold is also holding in slightly higher today. That chart has looked pretty good for the most part as gold just continues to show up as an outperformer and a steady winner in the market, basically no matter what else is going on. So that's the situation. VIX at 16, very calm. Almost a flat 16 for volatility right now. So that tells you that things are pretty low key. And I think in the absence of news, you have a bullish trend behind you. So that's pretty much where we're at. Today, I'm joined by Hans Albrecht, CEO at Gamma Options Solutions, is going to help me pour over some of the recent themes here and also, obviously, the volatility side of things, which is a big part of this story. Hans, how you doing, sir?
Hey, Oliver. Good to see you again.
Thanks. Good to have you back on the show. Look, volatility seems to continue to subside. It's pretty quiet here at Cboe. They're watching some golf. Obviously, VIX 16 means there's not a ton of action. Making fun of me for spilling my drink. So I guess that's the sign of a market that's in kind of chill mode for the holidays.
They're in chill mode and quiet. You know what they say, don't short a dull market. So I think the Bears are
right?
Exactly. The Bears are set up for something difficult over the next little while, which is really a quiet market. We've got, as you said, the volatility is dropping, so we see that realized volatility compression. For the viewers, that means just actual movement is starting to compress. And from the side of things that I watch, that means some of those systematic type strategies start to come back into play, right? So the CTAs, the vol control funds that basically when, they're like the Terminator. They don't think, they have no emotion, but when volatility comes down, what do? They just start buying the market again because that's what their mandate is. So we have these things that become tailwinds.
Speaking of tailwinds, I'm just going to look at some of the economic data here from the last 24 hours. Jobless claims, I think, is at 191 versus the consensus 225. That doesn't hurt. We do have inflation coming in tomorrow, so we'll see how personal income outlays shows up. Obviously, I think we want to keep that year-over-year number below 3%. But all of this has basically meant the Fed odds are like rock solid for a cut. So in addition to kind of the systematic buying of a bull market, you also have, I think, an economic and macro narrative that so far is also, to your point, if it's dull, which it kind of is, don't fade it.
Yeah, and look, it's unfortunately on the employment front, the ADP is kind of that bad is good kind of setup again, right? So
yeah, and the weak stuff too, you can find a narrative for, right?
Exactly. There's always something, unfortunately, that's kind of the direction we've gone. And we talked a little bit about it last time. The reality of this new world is probably incredible productivity coming out of AI, where people don't really need to hire. They may not be firing yet in droves, but it's really this situation where profit margins are going to improve. And, it doesn't have to come at the expense, quite literally, of having to hire people. So this isn't like, 25, 30, 40 years ago where you want to build something, you got to hire a whole bunch of people. Well, now you can do a lot of things with very, very few people. And that, in all likelihood, we're going to get that rate cut. And I don't know if they're going to be chasing their tail, because cutting rates isn't going to really help in a lot of ways, because what are companies going to do? Well, they're going to invest more in the things that, avoid having them have to hire people.
Yeah, no, it's very well said. Productivity, right? I mean, there's that chart that was going around that showed number of job openings in the S&P 500 and the way they uncoupled, and I mean that's kind of the point to some extent. Looking at the chart, by the way, looking at Nvidia today, holding 180. I think too that's important to see some of those leaders. I know you were watching Alphabet, and that's one that I've been talking about quite a bit, because as a Google phone user, the Gemini AI is great. And Gemini is also currently ranked right now on Kalshi as like super high odds of being the best ranked AI by the end of the year. So it's sliding into the home plate finish there as usurping that title from ChatGPT this year.
It really is. And so we heard about Sam Altman, the head of OpenAI, ChatGPT, saying, it's all hands on deck here, because it's a red alert, basically. I don't remember the exact words he used, but it was basically, they're worried. They're worried. And I think there's a very, very good reason to be worried, because Google has emerged from being considered almost like, one of the three stooges, not really kind of resting on their laurels, their search dominance, and not really, the feeling was that they weren't really doing what was necessary to keep up in this world. And they have shown the absolute complete opposite. They are taking control of almost all areas. And they're the most diversified AI stock out there. And that's going to be a very difficult reality for OpenAI, because Google has trust. They have all the data. They've got YouTube. They have so many incredible things going for them.
Yeah.
It is
Great
trust,
point.
right? So if I'm looking at potentially aligning myself and using Google, OpenAI's tools, I know this is a company that is under pressure to produce some revenue. They're going to cut some corners. They're going to do things. I'm riffing here a little bit, but this is when it comes to your existential outcome, which is really what a lot of companies are looking at these days. They're going, man, I better get on board with this AI thing, or I could be in trouble when my buddy down the road, my competitor, doing stuff, I could be in trouble. So who am I going to go with? I'm going to go with Google. They've been around forever. That trust factor is huge.
You seen anything in terms of, I know you screen for stocks that are trending, but also have enough implied volatilities and premiums to generate some income. Is there a way to trade this as it's kind of stuck up here around $320 after a nice big breakout?
Yeah, so they've compressed I had a nice broken wing upside fly on this thing, and so it's kind of just sitting in there in that pocket. I call it the profit pocket, where now you've got that compression of volatility that's really helping out as you're in the right spot on that fly. I think probably the compression, most of the compression is behind us at this point. You can find some interesting higher level option pricing in some other areas. It's kind of interesting out there. You're seeing some areas come down a little bit, and some are hanging in there. So it's there. You got to kind of search around, because what we're seeing out there, Oliver, is that the thematic, the factor vol is off the charts. It's high, right? Momentum, all these things under the hood, whereas SPY volatility has not really been anything to write home about. So there's a lot of movement going on under the hood, which is something you'd expect in a world of massive potential disruption. People are trying to figure out how they want to end the year and how they want to start next year.
Yeah, very fair. The potential to start the year with some degree of rotation is something I know you're also watching as well. Today, what stands out to me is the IWM or the Russell, however you like to trade it, the ETF IWM at 251, very, very close to breaking out. And even though, we've had moments where it looks like it's a false, it's been a false start for IWM, and it's only up 4% in the past year. You obviously have to kind of have those prefaces before you talk about small caps. They have been laggards, but you know, they're about to make highs, and they're a little bit closer than the S&P 500 is right now.
The small caps never make it easy for you, and we've had a lot of false starts over time. But I've been talking about this for a few months. I really, truly believe that as we move from that training phase of AI into a much deeper part of the inference phase, which is really, okay, it's not about NVIDIA and chips as much anymore, although the build out continues. It's really about how does everybody else benefit from this, right? What's in it for me? How am I going to make money? How am I going to improve productivity? How am I going to innovate? And that's what the inference phase is about. And it's a very, very important phase because it involves 30, 40 times more compute. It is the gears never stop turning, right? Think about what you do at GPT. The gears just keep going. It keeps suggesting things for you to do. So it just keeps going and going. And that is going to require a lot of power and all these things we're talking about when it comes to AI. But it is a fascinating stage. And I believe that means we're going to see a continuation of broadening into small cap. We're already seeing some nice profit margin increases in the mid cap area. That's going to move into the bottom. So I've sort of put forward that, listen, it's a bit more about moving out of the builders to some extent and into the users of AI.
Okay. I think that's pretty fun. The idea that this thing can start to show up in other areas, whether it's healthcare, whether it's, education, there's a lot.
Healthcare's had a great run.
Yeah.
Look
we
at
talked a little bit
healthcare.
yesterday at UNH, that's kind of a separate story, but today it gave some back.
Yeah, that's got its own sort of fleas, but one of the interesting ones I play, which is I'm starting to look for areas where there's a little bit of AI plus real, plus kind of a different area. It could be physical, it could be robotics. I think next year's going to be interesting for robotics. I think autonomous vehicles. I think Tesla could do well because we've already heard about drones and things like that. So the physical combined.
By the way,
with the
a good-looking chart. Tesla last week pushing back up to 450.
And genomics and discovery. I mean, I think it is absolutely massive. We are going to see incredible things happen over the next 5 years. So one of the ones I like, and I'm not endorsing this, but ARKG, for example, is that nice combination of we got AI, we've got discovery, we've got genomics, we've got all this stuff going on. And I think that could be a very explosive area that has yet to really kind of have that big run as we see that, I always sort of think of where are the positive headlines going to be? Think of the positive headlines in the healthcare sector as they go, man, we have just compressed the time to have to do something specific from 10 years to 6 months. I mean, that is a massive, massive amount of potential there.
Yeah. Chart looking pretty good for ARKG, by the way. Nice big rally today, 3.5%. I'm thinking about how we saw on semi yesterday. RIP, it gave some back. Microchip, RIP, but adding a little bit. There is a decent list of kind of secondary, tertiary, not exactly NVIDIA. I mean, look, Apple was beautiful too. We already talked about Alphabet, which was beautiful, but to see now some of the second, third tier players see these moves, it looks like a market trying to broaden out and trying to find, some breadth.
It is, and that's what happens in these manias, Oliver. Is you kind of get the tide floats all boats at first, and then after a while you start to figure out who's doing the right things or who's in the right place at the right time. So the semiconductor area is a little bit tricky, right? You've got some good, you've got some bad, and even in the data area, which I've loved as well, the Snows and the Palantirs, a little bit high valuation. So the market is moving into, think of it as the S&P 500. You've had 20 stocks lifting everything. Now you want to think about the other 480, right? What are the 480 going to do? Because a lot of those really trade at very interesting, compelling valuations. Take something, and finance too. Think of something like Goldman Sachs. I mean, these guys, the smartest guys in the room, JPM, Goldman, that is the low-hanging fruit in AI. They are going to save money. They're going to figure out ways to use AI to juice those margins. They're going to be in the right place at the right time. So I think you got to look around. It's a big, beautiful world out there, and don't just get stuck in the same old, same old.
Yeah. By the way, to your point about the banks, look at the chart at GS right now for Goldman. Really nice chart. On the verge of a fresh breakout. I pointed out KRE regional banks yesterday, always kind of the most hated in that category, also pushing to near 52-week highs. XLF at the high end of its range from the last couple months. Do these appeal to you in the same way as the tech stocks do, though, in terms of how they generate options, flows? Do they have the same type of trading structure that allows you to reap income and use options the way you like, and some of the big tech stuff that's a little juicier, more popular?
They do. In markets like this, so part of what I do is I kind of look for those income opportunities, but I kind of call it income enhanced, right? So when things start to look really good, and I have a number of indicators I use, then I start to do more things like risk reversals. I call it, the sort of a turbo strategy where you kind of use some of that finance from that income side to play some of the upside. So if there's one thing I hate is to give away too much upside, and so income is challenged in that way. There's some areas that are in breakout mode that have those great, enduring, durable stories that I think can benefit from a kind of strategy that actually uses something to finance that upside. And some of the upside's getting pretty cheap, actually, versus, a month ago, Oliver, I was looking at some of these one-year option prices were out of this world. Amazon, Micron was off the charts. Double the implied volatility of April's gigantic sell-off. I mean, we have seen some crazy stuff happen out there as people have reached for those upside calls. That has calmed down, and that gets me a little bit more confident to position in some of those upside calls for the next as we get through the holidays for next year.
Speaking of generating income but not leaving too much on the table, we're going to talk about some of those strategies that are being built into ETFs later on in the show with Matt Tuttle, who's been very much out in front on that alongside a few other major ETF players. What do you think the most common mistake is made, though, in that type of approach, Hans? Is it just lack of participation on the upside? How do you balance that by not just making sure you get left behind if the market does rip? Because I do feel that some people get a little bit focused on kind of reorienting, they kind of, sacrifice capital gains for a structured income, which for some, that is a preference, but at the end of the day, I think for most, they probably just want to make more money.
For sure. Look, and we can't paint everyone with the same brush. You have different goals at 25 than you do at 75. And so for some people, that really can make a lot of sense. People come to me and they go, you know what, Hans, I don't care about upside, but I don't have enough money to retire. How do I, generate something meaningful? And that's where that can be very, very powerful. But if you're young, you want to be a little bit careful because these strategies tend to be very systematic. They sort of do the same thing all the time. And, even when option prices are very low, they're sort of selling calls. And really, the thing is, we are in risk markets, right? We are willing to take risk, but we are willing to take risk because we want the benefits, right? I don't invest in NVIDIA because I want to give up a whole bunch of my upside and retain most of the downside. So you have to kind of wrap your head around the different ways to do that. And one way could just be, listen, I'm going to take, 30% of my, allocation, and I can put it in an income fund, but I'm going to retain some upside by just owning stock, maybe owning.
Right. Don't replace it. You're not swapping it entirely, right?
Exactly. Don't do the whole thing, because when you get a 1,500-point run like this, I have a lot of people coming to me crying, and I said, well, listen, I told you you have to do this more strategically, or you have to be a little bit more balanced.
Okay. All right. To that point, Hans, before I let you go, anything that's top of your list in terms of specific trades, in terms of going into the weekend and then the holiday season afterwards? Is there anything that is low-hanging fruit from your analysis, from your screens that you like?
Well, I think next year we're gonna have a bit of a commodity push. I'm a little bit worried about inflation starting to rear its head a little bit later on. We're seeing construction starting to pick up. I don't know if you saw that chart. There's a chart floating around showing that there is a massive build out to happen. So I think we want to keep our eyes on rates for a little while. And make sure that we're not over allocating, because if inflation comes back, we're going to be a little bit careful. But I like these ideas like Freeport McMoran. I love that. I love copper. I love those areas that are going to be, you think of it almost as the purveyors. They don't care who's going to win, like an NVIDIA. They don't care who wins, but as long as they just keep selling GPUs, right? So I like those picks and shovels ideas. So a little bit of commodities, definitely a little bit of broadening. I think the finance stocks like Goldman Sachs. Hood is one of my favorite. Hood is a fantastic play, and I've got quite a bit allocated there.
Okay, Hood looks pretty good. It's coming back again. Hood ripping. Freeport for some balance.
It's a nice way to play crypto as well, right? Crypto's been a bit of a you know what lately. It's been a difficult situation. So I kind of like that sort of balance of, okay, we've got Hood is, you know, it has that connection and betting markets and all that, but it has this whole other business of recurring revenue. So I like adding the real to AI, and that feels better for me right now.
Okay, love that. Hans, good conversation. Great to catch up. Thanks for the eyes on a few of the overlooked names there, FCX. And a nice little lesson there on how to not lose too much by collecting income, generating income. And a nice little segue for us, too, is we're going to talk crypto coming up with Mr. Matt Tuttle joining us. Be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. I'm Oliver Rennick. We got stocks a little changed on the day, in pretty good shape. It's time for the Cboe Exchange Traded Profile of the Week. And we're going to talk a little crypto. We're going to talk some income generation. We're going to talk some alternative strategies between crypto, gold, and the rest. Mr. Matt Tuttle joins me, CEO and CIO at Tuttle Capital Mgmt. Matt, great to have you back on the show. Good to see you.
Hey, same here.
So you guys have been obviously just cranking tons of funds under your guys' umbrella now. Everything from kind of the hot themes of income generation to obviously the crypto stuff that you were early in on with the long master, levered, both short and long. Maybe let's start on the crypto side, since we were just talking about that with Hans there. Crypto's kind of been a thorn in some of the growth and bullish-minded investors' side. What have you made of that?
Yeah, I mean, it has definitely not been a fun ride for crypto bulls, us being, in that camp as well. But, it's the same thing that happens to every asset class. Eventually, it's going to have a correction, sometimes a big one. And typically what you see is those are going to be great buying opportunities. So, personally, I've been buying. We just launched 2 new 2X crypto funds, Solana and XRP. We've got a whole bunch of DATs we might do 2Xs on. So we're still extremely bullish on crypto. It's just, nothing goes up in a straight line forever.
Sure, fair enough. Tell me about where you guys are seeing the most interest in funds. Obviously, it sounds like from your perspective, fundamentally, you're pretty positive, you're hopeful, you're bullish on crypto, but obviously people can express the other side of that trade too through your guys' short master fund. But I know you've also, just in October, you guys launched the 0DTE covered call for master, MSTK. So tell me what's most popular right now, what's sort of in vogue among your crypto suite, and I'm gonna pull it up as you're talking here.
Yeah, I mean, right now it's the BMNU, which is our 2X BMNR, Tom Lee. The Korean investors love that. It's probably on there. So, yeah, and under T-Rex strategies.
Okay. Yeah, going
Got to
down
be
here.
there somewhere. If it
You got a
isn't,
long
I'm
list
going
of
to
'em.
slap someone around. Yeah, all right.
BMN.
Should have been on there, but
Hey, that's a good problem to have. You guys are jamming so fast, putting stuff out.
yeah, it happens. Sometimes we don't tell the web guys, hey, by the way, we just launched a bunch of new funds.
Yeah, but the idea is you're
we've seen
going
a lot
long.
of inflows. Sorry.
Yeah, you're going long his growth stuff, basically, right?
I mean, it's long BMNR, which is an Ether DAT, which also you've got a little bit of the celebrity status, which worked really well for Michael Saylor for a bit. Not working as well for him right now, but the bloom is not off the rose for Tom Lee.
Sure.
And we're seeing a lot of inflows over there.
Charts hanging in there. Looking at BMNR right now. Obviously, it was quite a debut. The overall, I feel like crypto mindset is still generally one that's pretty excited about the treasuries, pretty excited about the DATs. That part I do think is kind of given a separate kind of avenue of discussion beyond just sort of Bitcoin number go up, which I feel like is probably a healthy thing. But Bitcoin number go down doesn't really help the situation either.
No, it doesn't. But then again, for people who are more nimble, who are traders, longer term, you want it because you want to be able to buy into those dips. And and you see some of this. Oh, Bitcoin's going to go to 1 million by the end of the year. I mean, no, it's not. And and price targets on Bitcoin are always stupid. It's not a stock. There's no PE ratio. There's no multiple to earnings. You're just making stuff up.
Yeah.
But it's an asset class that you've got a ton more people in. I think IBIT was a game changer. And now you've got an administration and an SEC, there we go, that's rabidly pro-crypto. The headwinds are there. This is not, 5 or 6 years ago. So we're still very bullish in this area.
Okay. Obviously, the leverage stuff has been very popular. What do you think kind of the tone on that is right now in terms of the way regulators, in terms of kind of the investing community is thinking about levered funds? Has there been any sign of, reduced appetite at all? Or do you think this is still the kind of preferred way for people to get juice in the ETF world? Is this sort of an alternative for them trading speculative options, stuff like that?
Yeah, I believe that's the case, and it's as strong as ever. Obviously, you look through our names. The past couple of weeks have not been kind to those stocks. We were seeing inflows though every single day. We weren't seeing people panic and get out. People were going in. Days MicroStrategy and BMNR and things like that were down big. We were seeing inflows into MSTU and BMNU every single day. Obviously a lot of people know the regulators kind of came out with some issues with 3X, 5X.
Right.
Totally to be expected.
Why is that? You just think there's like a certain level that they have a problem with, or what? 2X, 3X, 4X, 5X, who's to know where to draw the line?
Well, right now you draw the line at 18F4, which is basically 2X.
Okay.
If you asked me, hey, are we going to see 3X and maybe more? I still think we are. I think we're in the first couple of innings. Remember the spot Bitcoin ETF where, you could have easily made an argument that's never going to happen. And now it's got, we've got $1 gazillion in spot Bitcoin ETFs. And I think Vanguard just said, hey, if you can buy Bitcoin ETFs now on our platform.
Got it.
yeah, the SEC is not a fan of 3X. We knew they would not be. We'll see how that goes.
Okay. In regards to income generation, using options to turn growth stocks and volatile companies into sources of income, trying to address some of the bond part of the portfolio that people have been talking about, obviously tapping into zero DTEs and stuff. You guys are obviously big on this with the Income Blast ETFs. Tell me about how you're using zero DTEs, and as this increasingly becomes just such a popular space, like Eric Balchunas at Bloomberg used to call like big tech growth funds the terror dome, because there's so many going for it. But I feel like now the income-driven funds are just as much the Super Bowl of ETF competition. So tell me how you guys stand out and what you're doing.
Yeah, so you know me, I'm an options guy. My personal portfolio is pretty much all options. I love trading options, and and we saw what was going on in the covered call ETF space, and I was kind of horrified. I would almost never sell calls, and certainly not sell calls against volatile stocks I think are going to go up. We're actually, we do a monthly webinar. We're doing one on Tuesday, why covered call ETFs suck.
I saw that.
We're coming at it differently.
So how should we read it then? Because I'm looking at it, you describe it as a covered call ETF. So what are you putting on there to make sure you don't, fall victim to the same lag?
Different. Yeah, so what we're doing that's different is we are selling our option at some point intraday and closing it out that same day. So one of the big issues I have with covered call ETFs on stocks I think are going to go up. Like you want to write covered calls on Procter & Gamble, do that all day, every day. But,
you're leaving too much on the table for a big winner.
Exactly. You're giving up a bunch of your upside. And with something like a Bitcoin, a lot of that upside comes overnight and over the weekends. So I would rather be unencumbered overnight and over the weekends and just wait for an opportunity to sell a call intraday. And, every day, pretty much, MSTR and IBIT are going to give you an opportunity. You wait, let all the stuff go around 9:45, wait for a little bitty downtrend, scalp a couple extra bucks, and rinse and repeat the next day.
Got it. Okay. Now, if I'm thinking about the potential for any of the volatilities to subside, then okay, some of that potential kind of fertile ground dries up a little bit for some of that, but it seems like they're staying volatile, whether it's to the downside, or the upside. There's still quite a bit of swinginess, especially in MSTR. I've always thought that your levered short master fund should be just about as popular, but that's kind of reflecting my own kind of crypto cynicism and what Saylor's doing. But what about that, Matt? Why not use an MSTZ, right? The short version of your fund to hedge, to have because my whole thing all year has basically been you can be long stocks, you can be long crypto, memes, or whatever. As long as you short, MicroStrategy is a hedge.
Yeah, that was your trade. You were here, a while back saying
that's right. I bumped into Granite just.
Long Bitcoin, short MicroStrategy, right? And that was the trade.
You think MSTZ is a way to put that on?
Yeah, you could, for example, go long BITK and go long MSTZ. Okay. And there you go. You're long IBIT with a little extra kicker where hopefully we can earn some option premium, and your short MicroStrategy. Whether I would put that on today with MicroStrategy now arguably, I've seen some things where it's trading at a discount, but certainly that's a trade you can put on, and if you put it on when you were here, that would have been a home run.
Yeah, for sure. I'm looking at BITK right now, your covered call ETF for IBIT, zero DTEs there as well. All these roughly around 95 bips or so, and does kind of give us a fun way to think about combining some of these unique strategies, use the covered calls, get your Bitcoin exposure. Then if you still feel that there is a risk in master, then maybe go to the MSTZ. So you can certainly build together some interesting combos through the Tuttle funds, because you guys have continued to grow and put a lot out there. So we appreciate it, as always, Matt, for giving us the rundown. Good to catch up. Thanks for coming on.
Yeah, thanks for having me.
Absolutely. Thank you, sir. Matt Tuttle, CEO and CIO at Tuttle Capital Management. All right, we got Innovator Buffer Break. Then we're going to come back and talk some policy, some economics, and how we're setting up for the jobs report with the one and only Marc Lopresti, always bringing us great energy. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovator's floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak, making billions. And its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to the Cboe floor. I'm Oliver Rennick. We've got about 20 minutes into the bell here, and stocks are still basically unchanged. The S&P 500 all of 4.5 points. So let's talk some big picture and think about the economy as well as policy, including, of course, the much-awaited Fed cut that looks like it's all but a sure thing for next month. Joining me, Mr. Marc Lopresti, CEO at Market Rebellion. Marc, good to have you on the show.
Thank you, Oliver. Always a pleasure, my friend.
Likewise. So how do we describe the data from this week? I'm going to go with mixed because I prioritize the jobless claims. But if you look at pretty much any other, and I have some services, but if you look at anything else, we're kind of missing. What do you think?
Yeah, well, listen, I would say that the jobs data that we got so far this week is a little more than mixed. I mean, let's be honest. The street was looking for 40,000 new. We got 32,000 lost. Pretty big delta there between expectation and what we got with the ADP numbers.
Right.
Looking into that a little more carefully, Oliver, The companies that had 50 employees or less were the ones that took it on the chin the most. The leading sector within those smaller companies, information services. So starting to see even more of that AI creep taking jobs from humans, I think accounting for a lot of it. A little bit of a skew with the Thanksgiving break there and the numbers that we got, but still pretty surprising nonetheless, and showing overall a softer job market employment picture than I think most have been anticipating. The good, and that, of course, by the way, on the back of the Challenger report that we also got, saying that we've lost 1 million jobs this year. We haven't seen an overall loss like that since the pandemic, since 2020. So all of this gives us, I think, a lot of reason to be confident in the Fed futures. You know this, showing now that we're getting close to a 91% chance of a 25 basis point cut next week at the FOMC meeting. I'd argue it should be 50, but then again, if my grandmother had wheels, should be a motorcycle. That's not going to happen either, unfortunately. But it's definitely setting up. You can use that one for free. It's definitely one of those weird bad news, good news scenarios where a soft labor market is good news for markets. Yes, overall, the markets right now trading fairly flat, and I think we're going to see that continue until we get that FOMC meeting. But not if you look a little bit downstream to the small caps, to the quantum names, the small modular names, all of these more high flyer speculative things that just got the crap kicked out of them in the past couple of weeks. They are roaring back big time. Some of the best performing names in the market so far today. I'm talking Rigetti, QBT, D-Wave, OKLO, SMR, NNE, all of our favorites of these speculative high flyers, all of which, by the way, we still remain pretty bullish on.
I'm looking at the Defiance QTUM Quantum ETF right now as a way to just kind of benchmark it, and indeed, it is pushing back towards recent highs. AIQ, the Global X1, artificial intelligence, also moving in the right direction, not quite as juicy as QTUM today, which has been kind of my preferred way to play it. Obviously a lot of people like to trade the individual options instead of the basket because you can get a lot more juice that way. But I've been perfectly happy, just sitting in QTUM, or rather, hypothetically speaking, 37% up on the year. AIQ up 32. You mentioned Rigetti, up 50%, but obviously crazy swings. So you would have had to be really, really adept on the individual names.
Yeah,
but they are coming back.
Listen, these are not for the faint-hearted. There's no question. But when you have, like we had yesterday with Jensen Huang, NVIDIA's Jensen Huang, coming out making these comments on the Joe Rogan show, talking a lot about quantum, acknowledging this concept of Q-Day, right? The point at which quantum computing becomes so sophisticated that it will literally break the internet, Oliver. It will hack and be able to hack any encryption that we currently have. And that's
good thing it's not cheap to acquire one of those.
That's not an if, by the way, that's a when. And that's why Jensen acknowledging this, and look, this is the next wave, if you'll excuse the pun. One of these companies is going to get it right, and we need them to get it right. The Trump administration's behind it. So we like buying this sector on dips, similar with the nuclear names, small modulars, also something that Jensen talked about, because we won't get that energy we need for all those damn data centers without nuclear.
Look at nukes in UKZ right now, also ripping, still up 61% on the year. All of this does seem like it points to growth being the magic carpet for this market to go higher. You think we're going to hit records, Mark?
No, I think we are. I mean, listen, we knew, Oliver, that we were not going to get to the end of the Santa Claus rally for the fat man shimmering down the chimney this year before we saw a little bit of a sell-off, before we saw something that maybe started to approximate a correction. That's what we got starting in mid-November. I think we're coming out the other side of that. I don't see any major catalysts from a news perspective between now and FOMC. Of course, we're all going to be listening very carefully to see what Jay Powell has to say, not in the prepared remarks, but during the Q&A, the extemporaneous Q&A. He often puts his foot in his mouth to see just how dovish he remains. But look, we know we've got a new Fed chair. We know who it is at this point. I know it's not promised or guaranteed, but everybody I talk to in D.C. says we know exactly who it's going to be. It's Kevin. He's getting it. That's Trump's boy, and that
Kind of
means we're
seems
going
like
to
it.
get more rate. Yeah, I mean, I think that's a lock, Oliver. I really do.
Yeah. Well, even if he likes cutting rates, if Powell, I mean, it just seems like they're all fine with cutting rates. I know it's like too late to turn back. I feel like it's too late to turn back now in terms of the Trump and Powell relationship, right? I think that one's like, it's a little too late. But,
Yeah.
I mean, ultimately he still is doing, I mean, he's going to cut next month. I mean, he's still cutting. So it kind of seems like a little bit of a wash to me. Maybe it's more of a personality change and a statement or as much as anything.
Could be. Listen, I tend to agree with the president on this one. I think Powell took way too long to make the first changes. That's why we saw the fastest pace of changes in monetary policy, the fastest pace of rate hikes in the history of our great nation. That's not because he started on time, Oliver. That's because he took too damn long to make the first move. And that's a genie you cannot shove back in the bottle, unfortunately.
All right, fair enough. Hey, real quick, Mark, last point is another genie. I was just going to follow up on the point about the jobs. Here's the reason why I depart a little bit from some of the concern that you might have about recent economic data is because of this chart I'm going to pull up here. This was viral on Twitter X for a while, S&P 500 versus total job openings right at the ChatGPT launch. And I'm thinking, like, this is the way it's supposed to look. Like, that's productivity. But hey, I'm not showing up any jobs report. I'm out here just doing my thing because I got AI to support me, Like, that's productivity. Job openings, possibly. That's my argument. I'll give you last thought.
Well, listen, you can certainly be right, and I hope that it's not the draconian and Schwarzeneggerian future where the computers take over and we're all the Terminator. I hope that's wrong. I hope we're not living in a Terminator world. But there's no doubt that every time we get another jobs number, we're seeing more and more creep with AI. We're seeing more and more jobs being taken from folks, particularly in clerical positions, particularly in information technology positions, software coding. It's just the reality of it. It's happening, I think, faster than we ever thought.
Well, maybe that's where, look, I mean, this is kind of where I go like pseudo-capital socialist, which is we have these great tech innovations. Let's get a dividend check from whatever the country's exporting for all that power, and then let's stimulate all those people that lost their jobs and let them invest in the market. That's what we did during COVID. It seemed to work. So, but fun chat, Mark. You the man. Appreciate it.
Always a pleasure, brother. Thank you.
Likewise. Thank you very much, Marc Lopresti, CEO and Market Rebellion. Some good stuff there on the economy. We're going to take it into the closing bell with Mr. Scott Bauer coming up next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future Finance. I'm Oliver Rennick. We got 9 minutes into the bell, and I got Mr. Scott Bauer joining me here from Prosper Trading Academy as we get ready also not just for the bell, but Vegas next week for you guys' live conference.
What do you mean? Yes, we have our first live conference in Vegas, Tuesday to Thursday. We've got a ton of people coming in that want to learn how to trade, want to learn from people like you, just kind of macro info about the markets, what's going on. So we are really, really super excited.
You pumped?
We are.
Right?
I'm getting out there Sunday because I got to be in place for the Bears-Packers Sunday afternoon.
That's a big game, by the way.
It is a big game, but then everybody comes in Monday night, and we will get hard at work on Tuesday, Wednesday, and we'll figure out a little fun in there too.
You see the Kalshi odds on Bears was a little bit, it was off. It was like 30%. It was saying that Pac's going to win. It's also played in Green Bay, right?
It is played in Green Bay, yep.
Yeah.
We got 2 of the next 3 weeks with them. Next one will be at
the Nigerians are rubbing off on me at this point.
So.
I'm like, watching the football Kalshi odds.
Yeah, there you go.
Okay, so you guys, we're doing the conference. I'm going to be there with you.
Yep.
We're also going to be doing, I think, some pretty fun stuff in my wheelhouse of World Poker Tours going on at the same time. I'm going to interview up-and-coming poker breakout star Jonah LeBranch, the Phoenix Kid.
Can't wait to meet him.
Yeah, that's going to be really cool. I just talked with him today. He just won like $1.5 million, big breakout.
Hello.
Yeah, not bad. So a lot of things that overlap.
I will be a spectator watching all of that. I will not be partaking in the WPT stuff.
Yeah, well, that means it'll be busy. You know,
it will be busy there because it's a big tourney at the Win.
Yeah, staying at the Win, so come through.
Yeah.
It's going to be great. Prosper first conference. I'm excited.
We are too.
Market-wise, today's kind of slow.
You know what?
But in a good way.
In a good way, yeah. We talked about this the other day, right? I mean, this is not a bad thing here, seeing the market just kind of digest things, settle in, you know, not any big outlier moves, and kind of get its footing here. And, you know, I have a feeling that tomorrow's eco data, albeit that we're getting a lot of it, is not going to affect the market that much unless there's massive outliers because it's old data, it's stale, right? So I think that everyone's going to take it with a grain of salt. Say, okay, we're starting to catch up. We're getting more recent data, and we kind of go from there. And everybody's looking at the Fed next week, not if they cut, but what they say.
And then Hassett versus Powell afterwards. How do you feel about that? We were just talking about that with Marc Lopresti. I don't know. I feel like it's kind of a wash. It's more like a political statement, personal thing. Too late to turn back, you know.
Yeah, that's what I think it is.
Scorched earth.
Scorched earth. I mean, at the end of the day, when a couple years down the road from now, it's not going to make a difference who's in that role. Yeah. It really isn't. But I think there is some political parlaying going on right now.
Yeah. Okay. Fair enough. When you look at the potential, I think though, for cuts to kind of support the market. I mean, this looks like new highs on the way to me, does it not? I mean, we're so close here. The Russell's trying to do it right now.
Yeah, for sure. And one thing I think we have to be careful of is the low volume. So there, not a ton of conviction. When we did start seeing the rally come back last week, though, we did see the breadth really widen out. Now it's with the lower volume, it is cautionary to me, but I agree with you. I mean, the natural force of where things are going right now is definitely to the upside. And is that going to hold into the end of the year? Are we seeing the so-called Santa Claus rally now? Again, I think it's going to be so important what Powell has to say next week. And my gut is he's going to say. Yeah,
Mike. Some interesting questions.
Yeah, I think that he's going to say, well, we didn't have a consensus, and there's a mixed view, which would not be a good thing for the marketplace. And we're still fighting inflation, and it'll be interesting to see what the odds are of further cuts first quarter next year, because I have a feeling this could be somewhat of a hawkish cut, if you will.
And maybe that's the reason why then some would argue they want to get somebody in there different.
Exactly.
That's going to be more
Change
of a yes
that
man and just kind of like, hey, cut. Which I don't think that's what we need, to be honest. But I don't know. I feel like how could you really? There's so much temptation to want to go to the scenario that could have happened, right?
Yeah.
Whereas, what's the scenario that did happen? Powell cut, He hiked, then he cut.
Then he cut.
Stocks kept making all-time highs.
That's right.
Economy's okay. Like, it seems a little bit greedy to want more than that.
Yeah, and that's the narrative underneath the surface here is why are they cutting? Right? Outside of that, it sounds good to have rates lower, help the housing market, et cetera, et cetera. If they really feel this conviction to cut, is it because they kind of know the data that's coming out, that the weakness that we're seeing in the labor market is only going to get worse, that maybe the consumer, albeit the numbers have been really pretty positive, with the holiday season, maybe that's going to start being an issue here? So that is a big concern that I have, is if they really feel the need and it's less political and more economic, that's not a good reason to cut.
I think I'm going to go maybe a little bit off the wall here, but we also know there's a big crypto contingency in the Trump camp and the White House camp. And I got to say, if I'm looking at the stock market and I'm seeing AI doing incredible, leading the world, by a long shot. I know China's got good competition, but our AI is the best. Our stock market's right near highs. The only thing that's not doing so well is crypto. Yep. And we know also who loves rate cuts and is like a liquidity trade. Yep. That's the crypto camp. So I worry that maybe they might make a rash decision based on some influence from that group, to be honest. That's my kind of theory.
So to take that narrative, do you say that the big sell-off that we had last week in crypto, was that because probabilities of further cuts beyond next week, maybe people were looking at that off the table, but then how do we rationalize, we made a really nice comeback. We're still far off the highs. Made a really nice comeback in the crypto space here, but the narrative for a rate cut next week hasn't changed since that happened. Yeah. So I agree with you on the overriding narrative that there is a big faction out there that would love to see lower rates for the crypto space. But I'm not sure where we head in crypto from here.
The potential for a little bit of a bounce. Maybe we hit some charts real quick in the last minute here. What do you see in the market as potentially a trade into Friday, whether it's crypto, whether it's NVIDIA, whether it's IWM? I mean, some of this stuff is doing pretty decent right now.
It is. IWM, I think, is on the watch because we're up to some resistance that couldn't break through today, really.
Right, but so close.
So it's right there, right? And it's almost kind of a triple top if you look there. So does that mean it's ready to launch? Just bust out, or is it going to fail from there? That one to me is pretty critical, and obviously we know how closely tied the small caps are to what the Fed may do and what rates are. So to me, that's the big one to watch tomorrow, especially headed into the Tuesday meeting, the Wednesday announcement next week.
All right. IWM, Russell, see if we get the breakout move there. I really just think that if you've got the Russell able to do it, I think the broad market's going to do it too. We're already so close.
Agreed. It's almost, it's not the common theme to say the small caps are going to lead the market here, but I think that could be the one that takes everything else with it to get back to those old highs and make new highs. Yeah, no, I'm with you there. I think so too. I think the market is solid, quiet day. We end green, so that's not too bad, by a thin hair. Up there,
thin hair, but we did. Great to have you, Scott. I will see you
pleasure.
next week in Vegas, sir.
Can't wait.
All right, going to be fun. The Prosper Trading Academy Conference, first of its kind at the Wynn Encore during the WPT, but we'll be talking trading too. Thanks for joining Chicago Future of Finance. I'm Oliver Rennick. I'll see you next week. By the way,
from
we're
going
to do some shows from Vegas. Thanks for tuning in.